Hey everyone, welcome back to the channel. My name is CJ and I'm a software engineer and investor living in Chicago. And today I'm going to talk to you about one of the most important lessons Warren Buffett learned from the book The Intelligent Investor. And that's the concept of the margin of safety. The margin of safety is a concept covered in chapter 20 of The Intelligent Investor. Before we dive into how the margin of safety relates to investing, let's take a look at an example from engineering. Imagine a new bridge was just constructed with a weight capacity of 1,000 pounds, and you're a truck driver hauling a load that is 950 pounds. Now tell me how comfortable you are driving over that bridge. Wouldn't you feel a lot safer if you were hauling only 500 pounds, or the bridge's capacity were actually 2,000 pounds of weight? In the case of the bridge, the difference between the tonnage that you're hauling and the capacity of the bridge is your margin of safety. Now, relating that example to investing, suppose you've done your due diligence on Apple and you decide that each Apple share is worth $1,000. Now imagine Mr. Market, who we learned about in the previous video, is willing to sell you shares of Apple at $500. Now that gap between what you believe the intrinsic value of Apple is, which is $1,000 per share, and the price that Mr. Market is offering you, $500, is your margin of safety. The primary reason why the margin of safety is invaluable to investors is because it helps us avoid the number one thing that we hate most, which is losing money. In this scenario, we've valued Apple shares at the intrinsic value of $1,000 per share. But because we're human and we're fallible, we're bound to make mistakes in our analysis every once in a while. So say you bought the Apple stock at $500, but the shares are intrinsically worth only $750. That means you were off by 25% in your analysis. But because you built in a margin of safety, you still didn't lose money. You actually made a nice gain. In this case, our intrinsic value calculation for Apple would have to be off by 50% just to break even. At the end of the day, by making conservative estimates of a company's intrinsic value, you're building in a buffer that protects you on the downside from losing money, even if your calculations are wrong. When valuing businesses, a general rule of thumb is that the higher quality the business, the lower of a margin of safety you need to protect yourself on the downside. For example, valuing Facebook, Google, or Apple, their future cash flows are a lot more predictable, and therefore there's a lot less of a chance of a surprise on the downside. However, just because you don't require as much of a margin of safety doesn't mean it's going to be a great investment that provides outsized returns. On the other hand, cigar butt investments, dying companies, outdated manufacturing companies, and the like, companies that are ripe for liquidation, you should have a huge margin of safety in those because they're very unpredictable in what's going to happen, even if you correctly assess how many assets they have on their balance sheet and what it's all worth. There's no guarantee that that company will liquidate or go the way that you want. So make sure you build in that buffer price in your intrinsic calculation. We use the margin of safety in our daily lives, whether you're lifting too heavy of a weight without a spotter at the gym or making a conservative budget for your family. It can be summed up with the phrase, better safe than sorry. And in the case of your investments, you'd much rather be safe than sorry. The concept of the margin of safety is covered at length in The Intelligent Investor in chapter 20. Now, I think this is the most important chapter in this book, and Warren Buffett perhaps might agree. If you have any questions or comments about margin of safety or anything else contained in this book or in the world of investing, please leave a comment below, and I will catch you in the next video. Thanks for watching.